And how do you define steady state? Well, the reason I call it that is that many companies are not in a steady state. And some companies by definition will never be in a steady state. And some people call, instead of steady state, you call maturity. You know, 𝗕𝗏𝗏 has some interesting definitions of this, you know, what's a company at maturity, what's the growth at maturity, and so forth. But, you know, when you have a company that's, the products are planned obsolescence, right? This is the V100, this is the A100, this is the H100, this is the B100, you know, not exactly drawn to scale, but, you know, maybe it's something like this, you know. And so V100, A100, these are NVIDIA chips for anybody that doesn't know the lingo. These are the H100s. This is the B200, and then we have Rubin coming, which we don't know. Maybe Rubin's like this, right? And so you have this like planned obsolescence. So what's steady state doesn't make sense here. Whereas for Coca-Cola or something like that, it's a lot easier to value because you can sort of, the company, you know, started, had a big growth spurt, and you know, revenue sort of reached this sort of steady plateau, you know, of small growth, and maybe one day we'll have some decline. We can sort of model this. This is in calculus, this is called the area under the curve, right? We can just say, well, what's that, right? What's that AUC? What's the discounted AUC of those cash flows? Here, you have something a little different. It's a cyclicality that you have to understand. And the cyclicality is not just the product cycle, it's the business cycle, right? So you have a bunch of different things there, and you have a technology cycle now that's, you know, a little bit difficult to understand. And we're going to try to figure this out, but it's not going to be easy. And it requires some creative thinking. And in some ways, investing is a little like philosophy, where we don't really know where we're going. And part of it was we're trying to scope that out and figure out what to do. Checking back on the market, we got a little bit of a rally in our hated quantum sector here. So I actually want to look at, for a long-term perspective here, I kind of want to look at Intel, and I want to go back really far back in time for Intel.
I'm just, then why do some of the tweets say, oh, 67% is short?
Okay, so that, you know, okay, that's what
am I like misquoting that? Like,
no, that's what I wanted you to get to. Okay, do you know what a convertible bond is?
No, I don't.
Okay, so a convertible bond is when a company borrows money, but that money that they're borrowing, instead of being paid back, it can be paid back with shares of the company at a certain price. So when companies issue convertible bonds, what typically happens is the bondholders will short the stock, and that's called convertible bond arbitrage. So the bondholders are short the stock, and they don't care what happens to the company's stock price, because if it goes bankrupt, there's the secured bondholders. If the stock goes up, that's actually great for them because they convert their converts and then they dump the stock. So helping out, you know, the stock going up would be helping out the shorts. The bondholders or the shorts, they're rooting for the stock to go. They're praying the stock would go up. They're not getting squeezed.
So what's the timeline of this? This would inevitably lead to a drop. It's just about that then. I
mean, I think that, you know, there was always no float to the company at $1, right? The market cap was like 50 million. So it doesn't take much money to get the stock up. But as the stock goes up, the possibility of the worthless company being worth a lot, nothing's changed in their business. They didn't overnight become a good business. The reason the company was very close to bankruptcy, basically days away, the bondholders told the company, you have two options. We put you into bankruptcy because you're not going to be able to pay our interest, or you give us, remember they had like 60 million shares. So they had to give, I don't know if you read the press release, they had to give the bondholders 300 million more shares. So the bondholders are sitting here saying, bro, the stock's at 4. We just got $1 billion from these idiots. Why? And so they're dumping the stock as we speak to the people who are buying it, who are the bag holders. Nobody's short. Nobody cares on the short side. It's too small of a company. It's much more about the bondholders are getting the greatest deal of all time, because what's funny about the bondholders is they didn't just swap their bonds for more stock. Oh no, they are getting those 300 million shares, plus they keep their bonds. They just got it pushed out 3 years to collect.
But yeah, basically Cramer just wouldn't lose money. He refused to lose money. I think as an investor, I have to, it's really tough to say this, but like the thing about investing and trading and portfolio management and whatever is you don't have to be good at everything. In fact, nobody really is. You do that one thing that you do really well and you can become a billionaire. And I don't know that I'd rather, like, in terms of money management, I'm not sure there are more guys that I'd rather have manage money than Cramer in his prime. Because he really, like, was just a sicko. Like, every trade mattered to him like it was the last trade he would ever make. So that's who you want, you know, managing your money. And you hear from me saying, oh, I'll short more beyond at 9. He would have a heart attack. He would have a heart attack. He would have covered, gone long, sold it, gone short again by now. The guy was just like refused to lose. And he'd be working the phones nonstop. Yeah, okay, buy 200. Yeah, what's he doing? Tell me what he's doing. Put me up. Get me out. It's just nonstop lunacy. It was crazy to see. It was like worth the price of admission. When you asked him to make an investment, it wasn't the same exact thing. And again, my point isn't to disparage his investing skills. Far from it. He knows more than most people, that's for sure. More than most people on planet Earth. But what he was really Michael Jordan at was that risk management and trading. He was more like just a normal NBA player at investing. Maybe even not an NBA player. You know, but the point is, Michael Jordan wasn't very good at baseball, was he? He's not that good at golf either. He didn't need to be, because he was Michael Jordan at one thing. And that's the story of Cramer, right? It's just not that important or realistic to be great at everything. You know, I have the opposite gift. You know, I'm not a great trader. I'm not great at risk management. But I think I'm really, really great at investing. And the kind of long-term, it's overused and trite phrase, but the long-term PE style investing that includes buying and running companies, which I've done many times successfully, that's what I'm good at. The day-to-day psychology, the shadow boxing of you know, every movement in the market, that doesn't interest me, and I'm not good at it. And I don't care. It doesn't stop me from making money. But you just got to find out what you're really, really good at. And if you're good at anticipating future big rallies, great. Do that. If you're great at, you know, long-term investing and seeing what company's real and what company's fake, do that. You don't have to, you know, do everything. Was Jordan really good at baseball? I didn't think he was. Long short guys make money. I mean, there's plenty of billionaires. I mean, Buffett in his core is a PE fundamental guy. I mean, there's plenty of sales guys on Wall Street that make millions of dollars. Yeah, he was minor league, which is good, but not. He wasn't Michael Jordan at baseball. I think it is probably a mistake to do both, Jake. I do think you should really stick to the one thing that you're good at. Jordan won a lot of championships. Like, he really was, I think, the best basketball player ever. Yeah, some people are good at venture capital investing. Some people are good at, you know, every little thing is different. Got to feel what's comfortable for you, most importantly. But he was a really special basketball player, right? It's good to come at the markets from different perspectives. I think the quantitative perspective is wonderful. I think the private equity perspective is wonderful. You know, the long short perspective, just because if you do it long enough, like, it's kind of normal mode investing, and it's pretty hard. Obviously some people do it really well. Like the best long short guys I know are absolute killers. They make 30% a year. So it's not impossible.
At the stock prices, whether they're smart or not, and nobody ever looks at the underlying fundamentals. The fundamentals never lie. Over the long term, the stock price will always follow the fundamentals. A company like Beyond Meat is absolute poo-poo, right? It's terrible. They don't have any customers. Anybody who doesn't like meat isn't eating processed chemicals, and anybody who likes meat isn't eating Beyond Meat. They've got no customers. And I think a point that Martin brought up before, which is very astute, is like value isn't always defined as cigarette butts, Coca-Colas, buying things for 10 times free cash flow, right? If a company is compounding its revenue at 20, 30, 40%, like a company like Palantir, while also driving bottom line net margin expansion, right? It's hard for that to be expensive. So for you to come out and say, oh, it's trading at 300 times forward earnings, it's such a bubble, it's such a bubble. Well, you're wrong, right? Because the math catches up to it. But a company like Beyond Meat with negative gross margins and no real customers will always be zero. It's just a matter of time.
Yeah, I think so too. I mean, I think that's all correct. And the only thing I would add is, you know, you have the option value. So like if it was 10 cents, you know, or whatever the stock price was at the bottom, like you do have this option that like maybe they'll turn things around. But at $4, you're basically hoping that somebody else will buy the stock after you buy it, which is, you know, hoping could work. I mean, it might, you maybe even have a 50-50 arguably, but I'd much rather get into investments where I have a 90-10, where it would require something crazy for me to lose. And so like shorting quantum, or, you know, buying this, I bought a drug company stock recently called Sarepta. Like Sarepta is at 1 or 2 times sales. And in the history of pharmaceuticals, it's very, very rare to get these kinds of assets for 1 or 2 times sales. And, you know, there was still a risk, but it was like disproportionately likely that I would profit. Whereas Beyond Meat, I mean, you're just playing musical chairs. I mean, maybe the guy next to you will buy it for $5 and then you'll feel smart. But unless you could point to me where or why in the long run this stock is worth $10, $20, $30, why do I want to take that gamble? Yeah, the market will always offer you chances to gamble. You can go to AC, or I'm near AC, but you can go to Vegas, you know, tonight, and there's 85,000 kinds of games to play. But guess what there is not? There is no roulette wheel with 90% odds. They don't have that machine at Vegas. They only have money-losing machines. And the same thing is in the stock market, where, you know, most of the stocks you're looking at, 8,000 US stocks, there's only a handful that are really going to work out. And people look at the average S&P returns. Well, what that doesn't tell you is that the median stock does not do very well. It's those big companies like NVIDIA and Palantir that power that big average return. Because those companies get bigger, their representation in the index gets bigger, the average stock actually goes down over time. So when people say, well, you know, stocks go up over time, well, which stocks? Yes, Microsoft, NVIDIA, Apple, after the fact, you can tell that, yes, they went up over time. But just throwing darts at stuff like Beyond Meat, I mean, more likely than not, you're going to lose your money. And if you can't look at the balance sheet or income statement and say why you're right and the market's wrong, there's nothing wrong with being a contrarian and saying, no, the market's got it all wrong. What does the market have all wrong about Beyond Meat? You know, the market's saying it's going to drop. The revenue has been dropping. It's going to keep dropping. What are they going to do that's going to turn around? Now, if you sit down with the CEO and the CEO says, no, you don't understand. We're coming out with the Beyond, I don't know, they're going to do a drink. And the drink is going to be huge. Yeah, something crazy that's out of left field. Totally going to turn things around. You don't get it. We're going to be a SaaS play. We're going to sell software and meat. You know, something really wild that works out.
AI.
Yeah, it's AI meat. Totally AI meat. And, you know, that could work. And then you have a reason to believe. But at the current moment, you know, it takes a lot to turn around a company. Like, you can't take a dog and turn it around. It's very hard. So what's turning around here, it doesn't look like anything. And the product, you know, as Steve said, I mean, the product was tried for years and years and years and never took off. You know, the meat market is gigantic, and they got 400 in revenue. It cost them 500 to make just the meat. I mean, there's really hasn't been too many bigger disasters in capitalism than Beyond Meat. I mean, maybe WeWork. So this last gasp of like survival is, you know, again, it's almost like a gift to the bondholders and short sellers, and it shows the old saying that, you know, hope springs eternal and a sucker's born every minute, because it's just, you know, the same old kind of like people running to the guillotine.
𝗥𝗡𝗖𝗢𝗣𝗥𝗡𝗦. You know, there's another way. You guys want more tricks? I want me to do some tricks on it. 𝗥𝗡𝗖𝗢𝗍. It's this trick, 𝗥𝗡𝗖𝗢.com. Page is parked. What happens when it's not parked no more? See, I'm putting you on. I spelled it wrong too. Here we go. That's parked as well. I'm gonna buy it for $20. I'm 3 steps ahead. Now maybe a label pops up. If this drug gets approved, what does the stock go to 50? If I'm not mistaken. 20 calls are $5. So if the 20 calls are $5 and it goes to 50, I turn 5 into 30. That's a quick flip. That's a quick come up. All I need to know is it going to get approval? Ari's question, would payers reimburse? I don't know, man. I mean, yeah, I don't know. Okay, search did not return any results. Make sure that we haven't made the awful mistake of which happens in finance sometimes. It's basically one of the biggest mistakes you can make, which is you mistake cyclicality for permanent growth. And I don't want to do that. I know you don't want to do that. So we're going to try to figure that out. We haven't looked at Intel in a while. We kind of saw it as this kind of boring value stock that probably had some upside. They obviously had sort of a really, really big W or two. I'm going to close NVIDIA for now, believe it or not. Even though we're looking at NVIDIA, what I really want to do is understand long-term semi-cycles. And I'm going to go back in time. And I'm also going to do the same thing for Micron. And it's going to be a little tedious, but, you know, learning the history of your business is so important. Every time I talk to guys, I'll give you another example. You know, in biopharma, I kind of became like one of the most well-known guys in biopharma and one of the sharpest before the pharma broke, because I kind of tried to learn every company in biopharma history, including companies that had long been gone. And I did a funny analysis. I don't know if I have the file on me, but I did a historical biopharma. You know, let me see if I have it, because it's so interesting. I think give you an example of the links you have to go through to really claim you understand your industry. I mean, you have to eat, breathe, and sleep it all the time. Here it is. Ah, I found it. Great. So this tracks every pharma merger from 1849 to modern time. And so these are all the companies that merged into Pfizer to create Pfizer. William R. Warner and Company. This became Warner Lambert through the merger of Lambert Pharmacal Company. That became Warner Lambert. So William R. Warner Company was founded in 1856. Lambert wasn't founded until 1881, but eventually they merged a long time from now. They renamed William Warner Company Warner Hudnut, and they merged in 1956 to create Warner Lambert. Meanwhile, unbeknownst to anybody, American Home Products was founded in 1860. John Wyeth and his brother, John and Frank Wyeth, were founded that company in Philadelphia. And Airst, McKenna, and Harrison Limited was founded in 1925. American Home Products merged with Wyeth by just buying Wyeth. Stuart Wyeth, who was John Wyeth's son or brother, his son, died, left Wyeth to Harvard, of all places. Harvard sold American Home Products to Wyeth, or Wyeth to American Home Products, creating the bigger AHP. Now, if you've been around the industry, AHP was still public around 99, 2000. I used to trade AHP. So this is 1931. And there's Airst. American Home Products acquired Airst in 1943. So 1944, you have fairly big American Home Products. And we're going to put that on hold for now. And again, the point is, like, slowly but surely, Warner Lambert was public. It was WLA. Pfizer, if you notice, Pfizer's this little tiny guy in 1849, right? And all these other big companies are being created around Pfizer. So Pfizer's doing just about nothing. And then finally, the Pfizer-Warner Lambert merger in 2000 creates a major company. But Pharmacia was already, you know, kind of developing, and American Home Products was developing. So the big deal in 2004 was Pfizer buying Pharmacia. Pharmacia was PHA. And American Home Products was still public, changed its name to Wyeth, of course. And then, so Pfizer kept acquiring little companies like Medivation, Arena, Biohaven, Seattle Genetics, and that's where we're at in 2025. I have a few more of these to make, but the point is, knowing your industry's history is something that's important. I also know the drugs that these companies made. You know, Warner Lambert was actually the inventor of Lipitor. And if you know, the more history you know, when you meet people, if you know the people behind it, it's obviously not important to know the people from 1850, but who was the CEO of Warner Lampert? Is he on any boards right now? Is he giving any talks? Maybe you can go to a talk. And, you know, the CEO of Warner Lampert talk is going to have 8 people attending it, whereas the CEO of Pfizer talk is going to have 300 people attending it at your local college. But you could probably, you know, get a word in with the guy who was the CEO of Warner Lampert if he visits your college. So the point is, you know, knowing all these names actually makes it, you know, a lot easier to network, and when you bump into somebody, it helps. So Intel, it's no different in any sector. So in financial technology, which I'm somewhat new to, I have a financial technology startup you know, I've been studying the how S&P Global, for example, was made through mergers from McGraw-Hill. And, you know, it was a very fascinating thing how S&P Global became what's basically the largest fintech in the world now, bigger than even Bloomberg. So knowing the history of all that, I think, you know, really, really helpful and important. So let's see if we can get the revenue from Intel from as far back basically as we can go.